We should start our lecture, the last set, but maybe the best. Why not?
Previous lectures were very good, so it's very difficult to match.
Okay, Marion, the floor is yours.
Thank you. Lena asked me why I dressed in a tie. And this is the normal way I dressed when I give any class, and it would mean disrespect to this class to be less. But at the same time, I think it shows how you are expected to dress in a business school. If you are any time considering going to a business school, this is the way you should dress all the time. So you may reconsider. And second, when you go to the job market talk, you better be dressed at least half of the expected salary you want to earn. So you have to be very well dressed anytime you give a talk in a business school or a job market. This first talk is a very general one on topics I've been researching since 15 years. This was the topic of my dissertation. This was my second professional job, and it became one in where I applied many different fields or disciplines in economics to solving several aspects. So you will see that maybe some of them may be applied. You may apply your core advantages to public-private partnerships, because this is like a battlefield. We need all sort of tools, all sort of skills to go forward. So it's not that this is just only for economists, it's not only for game theorists, it's not only for managers, it's for everybody. Previous in my career, I'm not a typical 100% true academic. I am a sort of a second-hand academic. I started my professional life working for a big consulting company, Deloitte. Later I moved to a private investment company dealing with public-private investments in the renewal of city districts, an American company. Later I became advisor at the Ministry of Finance, dealing with the major decentralization reform in Poland. So I was the guy doing all because I knew Excel in the 90s, I did almost 400 budgets of newly introduced regional and county level administration units. Then I went to grad school, and after grad school, started working for an small investment bank boutique, and got appointed as Undersecretary of Finance in politics. So I was a politician. With all those dirts on my own career, the only thing I could do in academics is trying to combine them into something positive, which is public-private partnerships. So the experience in the private sector, in government, how to take advantage of that in academia. So again, this is a very general talk, and I hope that you may pick some topics where you can apply your own skills. So a very good, John gave how a good lecture should look like. A way that I would add to John's is, a good lecture has a good quote and a good picture. So this is my entry quote from Milton Friedman. When technical conditions make a monopoly the natural outcome of competitive market forces, there are only three alternatives that seem to be available: private monopoly, public monopoly, or public regulation. All three are bad, so we must choose among evils. Well, Mr. Friedman was wrong. There is a fourth, arguably also bad alternative: public-private partnerships. And this is the talk of me today. So what's a public-private partnership? This is the picture. So imagine we had breakfast, and in breakfast we have a bacon with eggs. Well, the hen cooperates in making the bacon with the eggs, while the pig is committed. In a public-private partnership, both sides have to be committed. What does it mean? That you risk, you invest, profits are shared somehow, and risks are shared. If the investments are only on one side, the profits on the other side, and the rates are not shared at all, this is a simple long-term contract. What we would like to have, to call them a PPP, is some sort of sharing of investment, profits, and risks. So what would be the story? Now, not to have the image of the bacon and egg, you may have the image of a large infrastructure. This may be sewage, it may be electricity, it may be a railroad, something that has a very long-term payoff. And these are sunk costs by nature, because they are not depletable anywhere else. They are natural monopolies. Natural because you may not have two sewage plants competing for water. I mean, you don't turn this water to that water. Or electricity, transmission. I mean, the production may be competitive, but the transmission in general it's a natural monopoly. It's of public interest because the payoffs, I mean, the society, welfare of society is directly related to that utility. Contracts are in general non-relational because one of the sides has a stronger power, the public authority. And there are a lot of information asymmetries in controlling quality. For instance, you may control the quality of water, but at a certain point in time, in a certain moment, in a certain area. But it's very difficult to control all along the way in a continuous manner. So this poses a the possibility of a double-sided hold-up. So many interesting things that we have been doing in contracting, in management, in investment, like are encapsulated in these projects. How we can think of it as a field? It deals with economics, with finance, with law and management. My core area of expertise is in economics and finance. But you may also think of those, as some of the papers that I have seen here, more related to the management, to the corporate governance of these units, or how that it changed the public administration view. Or it may also, if there are some lawyers, also private law in public law. But what I would like to I'm totally biased in this presentation. What I will show is how it incorporates public finance, corporate finance, IO, regulation, and institutional economics. The audience of PPP in general, in the first step, you can make a lot of money dealing with some core advantage that you have that you may sell to the market. So in the last term, of course, you may talk to scholars and present papers, but at the same time, you may monetize that knowledge into consulting or being part of an advisory board. Politicians are very interested. Just let me briefly say that the World Bank, yesterday, went a major reform where the core competence, the bank is like changed into a matrix where PPP is coming all across departments. Also in the European Union, we have more and more laws trying to facilitate the involvement of the private sector. Of course, bankers are very interested, institutional investors, legal advisors, and the academic world. But this is like a secondary market. We talk to scholars, but with the aim of making some, at the end, policy advices. So the story I knew. Now let's go a little bit more academic. The 17th audience, let's talk more academics. If we compare, as Milton Friedman was suggesting, only the three alternatives: public utility, private monopoly, and public regulation, or of a private monopoly regulated. In a public utility, the aim core is the aim of the planner is to increase welfare. And I am assuming here a benevolent public agent. So there is no corruption, maximizes utility. And that utility is higher than in the case of a monopoly. due to the simple reason that a monopoly would charge a monopoly price, the quantity goes low, and that is a welfare loss. Correct? Microeconomics 101. Profit is also lower than in the case of a monopoly, naturally. The private monopoly maximizes profit, but utility is lower than in the case of a public utility. Public regulation increases the profit comparing to public monopoly, but it's lower than in the case of private monopoly. Welfare is somehow also in the middle, depending on how efficient is the regulatory authority in regulating that infrastructure, and how costly it is, because you may have a very costly regulation. Now the question is, to what extent public-private partnerships can meet in the middle of increasing the profit for the utility and extracting somehow a share in that profit that would compensate for the loss of utility compared to the public utility. So the classic in-house make or procure becomes something more complicated or something more hybrid in the language of Oliver Williamson, where we analyze in-house versus procured and bundled at different stages versus a joint venture, public and private, or a long-term bundled contract. And everything that is in between the corners, the boundary solutions, we may call a public-private partnership. Public-private partnerships are very, this is a typical table you don't have to read. It's just to show how many dots are in different countries. It's not necessary to read it. Just in different countries, you have the UK with a lot of dots, many sectors that are shown to have been subject to public-private partnerships, practices of public-private partnerships. You also have countries where you have single projects like Lithuania, Luxembourg. I mean, Luxembourg is a rather rich country, so it doesn't depend on the wealth of the country where you go more PPP or not. Imagine that it's more of an attitude, not a necessity. Or you have countries like, for instance, Poland, where I come from, where you have several sectors that have been exposed to PPP. In the World Bank data set of private participation infrastructure in emerging markets and development economies, we see that there are thousands of projects. And these projects vary to the extent of concessions to divestiture, greenfield, or management, just only management. So it means less of an investment. It's more of a management contract. And also they vary how much private investment are in those total divestments. Also, you may classify in this data set that I will talk later on by sector, by type of commitment. So it's a very nice way of testing different things. Which sectors are suitable to PPP? So for sure, those which are marketable, that you can you can charge a fee, and they're of public domain. So this would be, for instance, sewage. I can charge a fee for water. I can make an investment, I can charge a fee, and it's of public domain, because we all are concerned. If it's of private domain, this is just only a private business. And the government just only regulates business as usual. If it's not marketable, then we have here a difficulty in how to collect the fees, right? Because how the private sector is going to monetize the payback of her investment. We see more and more that PPPs are going down in this way by shadow tolls or availability payments. For instance, in a prison, I mean, you will never charge a prisoner for his stay in a prison, right? But the government may pay, shall we toll, an availability. Oh, you are giving me this space in the prison, private sector, I will pay you. I mean, it's not the inmate that will pay you, I'm paying for him. Or some also roads that the government wants to have, although they will never be told, but the government says, if you make this available in winter, summer, anytime, I will pay you an availability fee. And of course, if there are activities that are not marketable and not public, this is of my own. If I sleep, I don't sleep, it's my business. Nobody cares, or too really. Although somebody may say that there are externalities to that, and it also should be regulated. Another way of looking at PPPs that may help you for those who are more interested in management is to think about the ownership or property rights, residual claims on one axis, and the other, the management. Who deals with the management? And again, it would be private-private or public-private. I will argue that anything that is in between the corners, and we have contractual solutions for any of those matters, and examples can be given. I would say that the joint venture PPPs somehow encapsulate all the difficulties that we see in other solutions. So by dealing with the central, this is the general solution to particular also problems. In the literature that is the prevailing literature, what we see normally is comparing the public provision to private provision, or public ownership versus private ownership, the extremes. But there are no answers to why we see so many compound hybrid structures that are stable in time. There are no temporally. So my view is that by answering why sometimes we have those hybrid solutions, we may understand better the current solutions. All the current solutions may be just only particular solutions to the central problem. Again, we may look at PPPs from many different angles. How it affects lobbying, or public choice, or how the vehicle is constructed. So imagine that I want to build a road. The government and the firms create a special vehicle to that, which may have also some shared public-private ownership. There may be also a regulator that regulates that utility, but it may be subject to capture. And these projects also should be financially viable. Otherwise, the private investor would never invest. And the way to make it viable sometimes is by guarantees or additional subsidies, because by themselves they will never pay off. So the public sector enters and says, I will pay half of the investment. And then you can run it. But this also creates to what extent this is welcome by the public at large. The decision makers are politicians, so they are subject also to accountability to their voters. And just to give a fast forward of what we'll see, sometimes we may choose not optimal solutions because of political constraints. And just saying that this is a not optimal solution is a very economistic perspective, because it's very optimal for the public agent. It's very optimal, the decision of not going for a PPP, because she is minimizing both the political risk and the contracting risk. And just assuming there is no political risk is a very strong assumption. Today I will try to pinpoint different things I've been working on, and just to tease you to go more into those aspects. One is, what about the capital structure, public-private? The second agency problems, governance of public and private utilities. Third thing, contracting. What do we find? The theoretical problems dealing with contracting apply to the setting of public-private. Risk measurement, and the last one that will be also part of the second talk, textual analysis, or more in a fancy way, algorithmic data reading. This structure is not casual. This is, as we may say, the cornerstone, or what are the drivers of PPP. So the drivers of PPP are fourfold. Investment efficiency, operational efficiency, the discount rate to the extent that is different and is not obvious for the private and the public sector, and the risk sharing mechanisms. All other ways of looking at the distribution of public versus private deals either with one of these categories or with the all of them together. Yes, and feel free to stop at any time.
Marianne, but you were just talking about the public choice considerations, but you didn't mention them among the drivers. So I would argue, in my observation, in a lot of underdeveloped countries, the preference for PPP that derives not from any of those, but derives from a way of, how shall I put it, hiding side payments. So that very often PPPs are a mechanism for governments with low capacity to both get something done while bribing all the relevant parties in a way that makes it look like it's an efficient transfer.
So what we're saying is a way of corrupting, or
in other words, assume projects are not.
Grants.
Yeah, no, but it's more than that. Assume that in practice, the way these countries are run, they can't get a project through without corruption. But if they did it openly, they wouldn't survive politically. On the other hand, there's no way the coalition will tolerate a non-corrupt project. So private-public partnership is often a way of getting it done, but spreading out the responsibility and hiding some of the transactions while supposedly promoting greater efficiency.
Yeah, absolutely. I will not argue that that's not the case. I will only say that this is not in the majority of cases, because otherwise you may have the public authorities being accountable somehow to either by the investors or by the public at large, and in the long run kick out. So it happens. I cannot mention any example. Probably you have more examples than I have of that practice. My only concern would be that this is not in the majority of cases. The majority of cases is rather a business practice.
Can I make John's point even stronger? I don't think it holds, it doesn't just hold in countries with low institutional capacity, it also holds in countries like the UK, where its PPPs are basically ideological. There is no empirical evidence they've delivered any cost reductions whatsoever.
I will try to argue with that.
With the empirical evidence?
No, with the ideological drivers of PPPs.
Okay, but what about the empirical evidence?
Empirical evidence of what?
Of the fact that PPPs haven't reduced costs as they should do.
This is very early to say, because you're not accounting for all the costs along the lifespan of the project. You're just saying that I'm charged higher fees, but just to show up, we do not have the counterfactual. What would be the taxes if I had to have a sustainable budget without the private sector involved?
Marian, it's from here. Can I offer a sixth interesting anecdotal part of evidence? In Belgium, there's a lot of criticism now. We had a few railroad PPPs and other things. And it seems to be what was happening is the government was under pressure to keep its public debt below 100% for all kinds of reasons.
We are going to talk about that.
Exactly, in UK. And so what they do, they finance something. They could borrow the money themselves at 2% at the moment. But then government debt crosses the 100% hurdle. So they go in a public-private partnership. The private partner knows the government is under pressure, so they ask a yield of 15, and they get it.
It's accounting.
They get it. And I'm not saying all PPPs are like this, by far, but what I'm saying is quite some of the PPPs at the moment are not driven by the inherent potential benefits, but by something much more down to earth, hiding the government debt.
The next time I give the talk, I will start with all the hot issues by PPPs, because it seems that this will raise the attention of the parties. Absolutely. You're totally right that there are corruption issues, there are inefficiencies, apparently, if this may be efficient, because evidence shows that fees went up. Evidence shows that it's not a question of efficiency, it's a question of effectiveness, where the difference is that to have the project done, I have to pay a higher fee, because otherwise I'm constrained, debt constrained, so I push part of the debt to a legal entity that is not part of the government, and I hide some debt. All this is true, but let's now try to assume a first best where the corruption issues, efficiency issues, and debt is not part of the main problem. And in the next sections, we're going to try to point it out, what if? We come back to political concerns of the agent and how she is accountable. We're going to come back to the fees. If accounting for total fees, this is more or less efficient. And we are going to come back to debt. And if I don't, please point it out. So the first one is a question that I made from my early work in my doctorate, was to see why is it that we have 25% of cases of PPPs where the private investment is something between 20% and 80%. Because we have models to explain why it should be private or why it should be publicly driven. It's always of public domain. So again, to make it, I'm making the shortcut. This is always regulated. It cannot be out of the public sector. So it's always the task of the public sector to run water and sewage. It's always the task of the private sector to run, to provide electricity. It's always a task of the public sector to provide some sort of transportation. The problem is who is financing and who is managing it. So it's always of public domain, that's clear. But that said, why is it that sometimes we have solutions that are hybrid? What is the explanation of that? Why is it that we have projects where the private sector involvement is not 100%, neither 0% with just only the management? So one way of looking at it is, this is driven by the cost of capital and a managerial advantage of the private sector. So the first thing is, which is not obvious, and I will go very fast, the discussion from the 70s, whether the rate of discount of the public sector should be lower than the private, is still ongoing and it's not finished. It started with big names like Arrow and Lind, and it's still ongoing and not finished. So some academics argue that the rate of discount should be the same for both the public and private sector. Because even if the public sector can raise debt at a lower cost, is because she will later on tax you more or expropriate. So in equilibrium, this rate should be the same. And the United Kingdom is applying a 3.5% to all projects. So no differentiation. Other scholars, even from the UK, argue that the rate of discount should be lower for the public sector because of the risk-spreading capacity of the public sector. The public sector somehow is charging to all citizens through the tax system in a project. And by this risk spreading, not the risk pooling in different projects, the risk spreading, who is the owner, so by dispersing the ownership, it becomes risk neutral. Therefore, the discount rate for the public sector should be lower. So assuming that the discount rate is lower for the public sector, there is also evidence that the private sector has some managerial advantages over the public sector, skills and technologies that are more advanced than the public sector. This was not the case maybe at the beginning of the 20th century, where the public sector was like the essence of all the core procedures. Who had the procedures? Not the corporations, but the public sector. The Bismarck German administration, they had the procedures, they were very efficient. Well, now we may argue that it's the other way around, that procedures and technologies and skills are more advanced in the private sector. So if there is a differential, a managerial differential, that is in the private sector. So the private sector can invest I, where the public sector, to get the same result, has to invest I plus J, so an additional cost. And instead of looking at the boundary solutions, I would just put it in a simple variable theta, which is the co-ownership and co-governance of the sector. So this, you may recall this graph. If you would have done this in the 80s, in 2009 you would got the Nobel Prize. Oliver Williamson got the Nobel Prize for saying that when assets go more specific, you have different government costs. So this would be the market solution, this is the in-house solution, and this is the hybrid. By the same token, we may think of ownership of yes. I will. Now we can say it more. This is ownership. Public ownership, private ownership. And the total cost is both the cost of financing plus the fee. So whenever I go more private, the fees are going to rise because the cost of financing is higher. But at a certain threshold, the know-how kicks in. And I can invest, I don't have to invest I plus J to get the same quality, but only I. So my fees divided in time goes lower for the same controlling for profit. Then as I go more private, my financing is again becoming more costly, and it goes up. So there is, in theory, some central internal minimum that is neither public nor private. This may explain to what extent some private partnerships have a mixed ownership. So this is the question. Why some PPPs have mixed public-private ownership? One way of looking at it, the differential in the cost of financing and the managerial differential. This is in a discrete model, and I'm putting off all the math. In a continuous model, the more you go private, the managerial advantage of the private sector has a higher impact, so the compound cost of financing and charges goes down, but then financing takes the lead, is more costly to finance privately, and costs rise up. Depending on this differential, sometimes the differential in the cost of public and private is so minimal that the solution will be go totally private, or go totally private, because everything will be captured by the differential in the cost. Or if the public sector is very efficient, therefore any differential in the cost of financing will be on the advantage of the public sector, so the solution will be on a public provision. But when the conditions are that the differentials are big enough of financing and
managerial advantage, we may have internal solutions. Internal meaning that the ownership is neither public nor private.
So if there's no know-how difference or transfer, there's never an interior solution and you never get optimal public-private partnerships.
We are not looking for optimal public-private partnerships. We are looking for optimal provision. And what is the financing, the optimal financing? If, as you mentioned, the managerial advantage of the private sector, or how much the private sector can save in outlays at the very beginning, is very low, so why would you have the private sector? They have more expensive financing, and they are not that better. So just keep the public solution. I mean, the public provision of public.
That's my argument of the beginning, actually. So I would argue that the private sector has a financial advantage, not in the sense of hiding the government debt. It's for the government, which has a 4-year election span ahead. The cost appear later on, and now I can hide that, and that's so there's no discontinuity. There's only an upward sloping line in that sense.
No, you're talking politics. We are going to talk politics in a while.
Okay, no worries.
But now we are assuming a benevolent public agent, and we are assuming a benevolent public agent. Then we are going to complicate it more.
Marianne, if we take this schema as accurate, could we test weekly, not in the Sebastian Galliani, this is really rigorous sense, but at least at the correlation level, couldn't we look at a bunch of countries' public-private partnerships and sort of say, these countries' public-private partnerships seem to be more in line with the putative efficiency justifications for it? That is to sort of say, using what we roughly know as the different assumptions about capacities or whatever, we would sort of say country X has a lot of PPPs that are plausible, whereas country Y, the conditions are so out of whack that there's almost no conceivable way in which, given the numbers we observe, those PPPs make sense versus pure public ownership or pure private ownership. Could we do that? So in other words, for instance, you had a characterization of when things are basically private, marketable, and so forth. But there are countries which will do PPPs and things that are like that. Similarly, there will be other arrangements under which, they have the PPP, they can't, there's no particular advantage in the private sector, and the costs are out of whack, and there's no particular savings. So you would sort of say, or there was no particular gap between private and public in the way that you would predict. So you could just somehow categorize them. You'd sort of say they have 8 PPPs, none of them look even close to the justification of Marianne. Whereas country A, it's kind of iffy, but it looks like all of them are plausibly within that range. Couldn't we do that?
Absolutely, and I'm working now with the World Bank in that characterization. The problem is how to capture by country the differentials in productivity by sector. So this is very granular and it's very difficult to capture. We are using some other proxies like the bond rates for the cost of capital, the treasury bond, corporate bonds to capture that differential, but the productivity is very difficult to capture by sector. So how much is the private sector more efficient than the public sector? We have anecdotal evidence exposed for several projects that were already done. That, for instance, if I'm correct with the statistics, the UK made a report where 90% of projects that were done under PPP were on time and on budget. And only like 1/3 of the public projects were on time and on budget. Yes, go ahead.
But on budget is very endogenous, right?
On budget means the budget that was planned by the public authority. Yes, I mean, but you're assuming that the public authority is not accountable. I'm assuming it's benevolent. You're not assuming it's not accountable.
So I realize this isn't rigorous, but could you also try it as a first step? This wouldn't prove anything, but as a first step for trying to find ways to analyze it where the data are too granular. couldn't you look for patterns? So for instance, if we looked at countries which we would all agree are generally richer, more efficient, have higher capacity, even the UK, despite Sasha's concerns, if we added like Western Europe, North America, and looked at roughly the characteristics of their PPPs and the rough measures, since we have better data for them on budgets, on time, on production, and compare them to the developed world, where very often the PPPs are not only not on budget or not time, but they don't deliver, they don't start at all. So more than a few of the biggest PPPs in the Philippines are not allowed to open, even. They do not finish, not on time, they do not finish in the known time of the known universe. And if finished, are not allowed to operate. That's right. So I mean, if you looked at, say, a set of a dozen countries with problematic PPPs, where they would dwarf, minor nitpicks like, did you make money? Or did you exceed the budget? This is like in the realm, this is the kind of debates that first world countries have.
This is absolutely very interesting, because we are dealing with, it shows how hot the topic is and how sensitive to the public. But on the other hand, it shows that we can only measure, you're saying many projects do not come to completion. Why I can only talk of what I can observe. So we do not have in this data set projects that were not completed. So the counterfactual is very difficult to collect data also on projects that were not accomplished or that were renegotiated. There is also a bunch of guys analyzing renegotiations in PPP, showing that sometimes you can extract more rents, or this is total corrupted area where you can deplete or deviate public money into some sort of private gains. What I'm just only trying to say is to frame why some things happen in an ideal benchmark world. And then we can talk of other things. Because if we just start, PPPs are nonsense because it's public money deviated to private investors. And then the talk is, I'm bold, so I'm stupid, right? So, or you're whatever, you're a Manchester fan or a Chelsea fan, so I'm not going to talk to you because I'm more of a Barcelona. And then the talk becomes less academic. Let's try to set down what we can model and what we know. And from there, we can talk about the deviations. Another way of looking at it that I've been doing myself is, okay, let's assume the cost of investment already done, sunk cost, either public or private. Now, management could be also private, even though the asset is public. French model, what they call the French model. So this will be the public authority investing, but then given in a contract in long term. Sometimes we have public or private provision. And sometimes we have like a hybrid of public-private management. Why does it happen? Well, so let's imagine a comparative of public versus private versus regulated monopoly, where we have large sunk cost and also decreasing. So we have a natural monopoly, we have convex and increasing marginal cost, and we have a two-part tariff, where the fixed part of the investment is covered by the fixed part of the tariff. So that's off, and we are only concentrating on the marginal cost, which is the operations, is related to operations. And now, again, let's imagine that we have, let's assume that we have some inefficiencies rising in public ownership and regulation cost rising in private ownership. Because the more private, I don't know what quality you're going to deliver, therefore I have to control that quality of the delivery of the good. If it's public, again, the public authority is benevolent and delivers good quality because it's also accountable to the public, but the private make high quality, at least for one stage, certain time, and cheat on that quality. And instead of assuming a boundary solution, public or private, also let's assume that we may have a continuum. And that poses two things. On the one hand, and I'm only showing the solution without the math of the continuous model, we may also have that when the regulation costs rise in private ownership and the efficiencies decrease in private ownership, the internal solution may be in the middle. A way of understanding it more easily is more in a discrete mode. Imagine that I'm the public authority, and I'm not going to regulate myself because it's in-house. But when the private ownership is bigger than certain threshold, I will regulate it. So I will have to incur some costs to regulate that, the utility. And that will somehow go into the total cost or into the fee. It has to go either to taxes or to fees. By the same token, when the private ownership is zero, I have some inefficiencies of running in the operations. But when the private investor sees that she has a minimum amount of ownership that safeguards her property rights and residual claims, she will say, okay, I provide my know-how. If that stretch between the two thresholds is not empty, we may have an internal solution where the cost of inefficiencies, the managerial inefficiencies and the regulation costs are minimized in an internal bound. And again, it depends on how much are these regulation costs and how much are these inefficiencies. Countries that are more developed, probably they have better public administrations. This differential in the managerial advantage is lower, therefore they may provide more of public investments. While the more developing countries are forced into the solution to go private, or you may have more inefficient private investments because the private sees, oh, the public sector is so stupid, they don't have the know-how, therefore I can force more higher fees or push more inefficient projects. White elephants, as already called. White elephants is when you invest in something that doesn't deliver. And a public investment that is out there of public money, but doesn't pay off. So we can, again, now put into one the ownership structure, the managerial structure, and come with very fancy graphs where if you have an internal minimum that is below the corners, you say, oh, public-private partnerships work. I'm skipping all the math, but in any case, what I'm trying to show here is that we may do very fancy economics just putting together the public and private. What about contracting? So now we go more into politics, more into risks. These are significant investment costs. And the public and the private parties are not equal. So one may expropriate the other, and the other may cheat on the first one. So this posed a lot of risk of opportunism or double hold up, and may deter any investment ex ante, because if I know I will be expropriated, why should I invest in an investment which payback is 30 years from now, 20, 30 years. So this we have for long-term contracts, we have seen solutions given by Stigler, complete contracts, or incomplete contracts, or renewable short-term contracts. But neither of those are perfect solutions. One solution that I post, and I squeeze more quickly, is to introduce bailed out and exit options. So instead of having a contractual clause that will kick penalties, let's imagine that we give the private investor the right to exit at a certain price. This is the exit option, or the put option in finance parlor. And the public sector has the option to bail out at a certain price. That will be a call option in finance. While the contract is profitable for both parties, neither of them have the incentives to breach. Because either I have this outside option at X, and while I'm coming above, I do not exit. And again, the public sector doesn't have the incentive to over-regulate or expropriate, because I know the price at which I can expropriate ex ante. So this is like...
I see where you're going. That's very interesting. But what is the difference then? I mean, exit bailout options are also essential in any joint venture. So if I see Belgian companies doing a joint venture with a Russian company, I always tell them, make sure you negotiate beforehand the exit and the bail-in and all the options, because
really?
Because otherwise the Russian partner will hold you up at some point.
In public investments, I haven't seen options applied. The only scheme that is applied to a large scale is Engels, Fisher, and Galitovich in Southern America, where they use the LPVR, which stands for the least present value of revenues. And this is a type of auction where they say the time is a variable. So what you auction is, what is your present value of the revenues you want to collect? You say 100, 110, 120. Okay, I give it to you because you are 100. Now, once you collect the 100, you are bailed out. If the demand risk is very high, then the period, instead of being 15 years, will be 17 years. But if it comes to be a very good project, and after 12 years you collected your 100, you're done. I mean, you return the assets to the private sector. Now imagine that the public sector says, you're doing bad, your quality is bad. I will expropriate you. What is the price of expropriation? Whatever you collected up to now, let's say 50, and the remaining 50. You said you wanted 100, so here is your 100. But this is the only case I know where this is applied ex ante as a call option. A similar type as a call option.
The only thing I want to say is that I see a lot of this in private joint ventures. And so my question really is... So my question is, what makes it special, but to the extent that this is a public-private partnership? What is the difference in...
Well, this is not a difference of public-private. This is the application of managerial practice from the private sector to the public. And this is what is very nice, that you can apply many of your core skills or knowledge from the private sector to the public, or contracting schemes that we know from the private practice to public-private.
So I would think one of the problems of this is in the private sector, you can think of a long-lived corporation as having credible commitment to maximize whatever it wants to maximize. With public sectors, especially again in countries in which you have very few credible commitments over the long term and rapidly changing administrations, then you have the problem that the promises of one administration over a, say, 8-year project, that's not the same as the incentives of the secondary administration to bail out. So in other words, I don't see how they can, because I've seen this, I can give you examples where they have a hard time committing the country, or they do it, and then the further administration doesn't like what the old one does and purposely reneges.
Absolutely. So here, this mechanism is exactly preventing from that. Because the second administration knows that if she doesn't want the project, I will expropriate. And the private sector is very happy with that because the price of expropriation is given ex ante.
I think it's really clever, but hold on. So, but if you both have options, then they need to be traded, right? Because the price of these options would change over time. So, but then if you're going to trade them, what information are you trading on? I mean, there is no public information, I think, unless you're going to load them with some sort of crazy accountability standards to make them disclose a lot of information so that thing can be traded. Because then it's not an option, then you're just putting something in a contract, right?
Well, the price of the option doesn't have to be a market price. The only thing that you need is a strike price.
But how does that get determined? Sorry, maybe that's a stupid question.
The strike price is determined ex ante, for instance, as the present value of the revenues.
But why is that called an option?
I know what is my internal value of the project for the private sector. Whenever that price goes below of the strike price of the exit option, I just go to the public sector and says, hey, I want it out. And you kick out. What you're mentioning, I don't know if that was the spirit of the question, is the secondary markets and the enforceability of the bailout option, of the exit option. Because if the public sector wants to be really bad, she says, I don't want to honor even the exit option. I will expropriate you, and even in the worst case, but you can overcome that with secondary bonds as a hostage, as a for.
Let me give you an anecdotal story from Russia. Two private companies. So there's the world leader in sand that you use to make glass is a Belgian company, Sibelco, for some reason. And they have a big mine in Russia with a Russian partner. So what happened? They were operating the mine. The Russian partner did all the connections with the government, of course, for the licenses. And then at some point it was going so well that they were going to double capacity. But now the Russian partner didn't have money to follow. So because the Russian partner became very paranoid and anxious, and they were afraid of dilution, what happened is, all at once, the road to the mine was shut down, and the company couldn't even enter its own mines anymore. So they kind of took hostage the whole company until they got a good negotiation. And so, and there are a few other cases like that. And since then, all the French companies put in their contracts clauses that say, if the capital will be raised, you can either participate at this price beforehand, or alternatively, we will buy you out with this price formula. So that all these risks and uncertainties are contracted away. You could call it options or clauses. And this way, and so that was my question. I think many of these things are just private technology applied to the public-private sector in a sense.
Absolutely, this is not rocket science.
But hold on. But then you're deciding on the exit price ex ante, then you have to put this in the contract. But that doesn't really solve the problem, because the issue is that if you build a school, you're committed for 30 years. Suppose you have a bailout option every year, but then something changes, right? Suppose you get online learning happening in 5 years and nobody wants to go to school anymore, right? You don't have an option, right, to quit.
To what?
Because you thought that your probability of leaving would be 5%, but it turned out to be it started changing.
Absolutely, this is a typical example when technology changes and you have
you've been pre-committed
option to bail out and reassign the contract.
No, but it was inefficient, right? Because you thought it was going to be 10%, and it turned out that it changed from 10% to say 20%.
Yes.
As the technology changed.
So instead of giving out all that utility that you are losing as the public sector, you just recollect them and reassign to a new contractor at a lower price, or at a higher price, depending on. But the idea here is, if technology changes, that's the typical example when you will apply the option. It's just thinking how to make, and now to summarize this part of the talk, is how to make a contract that by nature may be double-sided hold up into a relational contestable contract. So you make a monopoly a contestable market by introducing options. There are some issues into the enforceability of the bailout option. I mean, the exit option is always enforceable.
But the bailout option may not be enforceable. I mean, the other way around. The bailout option is always enforceable. The exit option may not have a secondary market, therefore may not be enforceable. But you may have some triggers through multilateral agencies, bond hostages that make it enforceable. But here is the idea how to make a market that is by nature a natural monopoly contestable. And that contract, which is not relational, becomes relational because both of the parties have equal or more equal bargaining power. So now what about the politics? This is a summary of a paper that is going to, hopefully, QJE. And this is my core paper. The political risks, how political risks are internalized, and how to put political risk into the picture. So far, we didn't have corruption, we didn't have political concerns, we didn't have third parties. So who are the third parties? The third parties are those who are interested in interrupting that relationship. And you, as a public sector now, you want to signal that you are good, that this project is, that I am not corrupted. And the way you do that is by more rigid clauses, more rule-based procedures, less discretionary contracting. But that comes as a cost. So the more you put those clauses, rule-based clauses, the cost goes up. So we have a trade-off from the public agent perspective of political costs diminishing in rigidity, but contracting costs are rising. The private contract, private to private, doesn't have political costs because it's only me and you contracting. If I want to buy your cell phone for $1 million, what's the problem? It's a private to private contract. However, if I'm the public authority and I want to spend $1 million in that cell phone, somebody is going to come and say, hey, here is I'm hearing some corruption. Because these are public monies. And by definition, we all have a public interest in public monies. Because these are public. So how do I signal that I'm not overpaying? Oh, I will put that the cell phone has to have these characteristics, have to be delivered on this time, and has to be of that kind. Just to signal that I'm really procuring a very specific item. But if the item is very specific, the contract is very rule-based and has a lot of penalties of not delivering on time, not delivering on quality, that will be internalized by the private contractor in a higher price. So there is a trade-off between political risks and contracting efficiencies. And this will be part of the second talk, how to measure that. Let's move in the last 5 minutes, right, to debt. And this is concerning your address. According to the European standards, ESA 95, for a PPP to be considered off balance, you have to have you have to transfer the construction risk to the private sector and at least one of both the availability risk or the demand risk, or both of it. What is the availability risk? If you have a road, availability means, oh, in Russia it snows a lot, but the road will be available. No matter what the weather, I will make sure that the road is available 100% of the time, or 99% of the time. And I take that risk independently of the weather, because the weather is very stochastic. Demand risk, what is demand risk? I don't know how many people will ride on this road. So if I toll the road, and it comes out that there is a lot of traffic, that's not demand. Well, over traffic may be also a risk. But if nobody comes to that road, I build the road, it's fantastic, full lane highway, and nobody wants to use it. That's a very strong demand risk.
And it happens, because it's very difficult to forecast 20 years in advance what would be the traffic from point to point. Yes, absolutely. And we have highways in, the typical example given here is the highway M1 in Hungary. Beautiful. Nobody wants to ride it because you have an alternative road that is for free. So the European Statistical Office says everything that has the construction risk transferred and one of these two transferred is may be considered off balance. Now, what is the problem? The problem is that what is considered to be transferred, or when 50% of the risks are on one side. So if 50% of the deviations are paid by the private sector, this is considered transfer. And if less than 50%, this is still public. In an ideal world, this may mean that there is a stochastic dominance of the risk on the private sector against the public sector. So in any case, the private sector will pay more for any deviations. But we know that risks are not just on the mean. That there are deviations, that we may have tail risks, and when something happens really bad, who is going to take that risk? The public sector. So it's never a first order dominance. Also because the methods applied, and believe me, I have done it and earned a lot of money doing this type of consulting. The way you consider a risk transfer is just only the expected value. You don't consider the tails. You do not apply the value at risk that is typical now, or the stress test in the banking sector for even bigger projects in the public sector. We just take, okay, this is how in expectations are the costs. If the costs go 20% more or 20% less, a scenario analysis, and what happens? But this is just only the deviations here. But what happens in the tails when really nobody wants to run them, or when there is an earthquake, or when something really bad happens? Who is going to take that risk? The government. The government is going to bail out. And that means that in reality, the ESA 95 didn't have the procedures how to measure if the risks are transferred. So one simple thing that I would change in ESA 95 is to say we have to run stress tests, banking-like, to see what happens in the low 5% of the deviations.
Another issue, very practical, with this ESA 95 is timing. So, for example, what happens time and time again, in Belgium, for example, they do some PPPs, and then 2 years later, someone decides, wait a second, they don't comply to the rules, we will have to increase government debt. But nobody cares. So the government debt 2 years ago was actually 8% higher than we thought. But by then there's new government, there's no punishment, there's no excessive deficit procedure because that was then. And so it's also the timeliness of this check. If it's not timely, it's going to be very ineffectual. And that's one of the problems today, I think.
It's incredible how much debt has been hidden in the PPPs that should be in public debt. Because at the end, the public would pay, either through guarantees or in an extreme. So ways to address that is to have models that are not rocket science. They're applied on daily day in the banking sector. And now even more with Basel III. And just to have them applied also to transactions in PPPs. The problem is that we don't have one data set to construct the whole distributions of risk. And this should be also addressed somehow in a pan-European case to collect data and more observations. One project that I have still in a baby stage is to have an engine to collect data from local governments where you will give them the distribution of risk for free, but you have to enter your data. So by entering that data and bootstrapping and what are the distributions in the different cases of risk, you get one more observation. And therefore, it's a learning machine. You give the engine power to make the calculations of distribution of risk, because sometimes local governments don't go for PPPs because they don't have the ability to compete at the same skill level with international investors. But now you're given that tool for free. But that's a side talk. Other tools that are applied in the public sector, in the public-private contracting, that I would like to just pinpoint is value for money, the public sector comparator, and project finance to the project finance mindset to public investment. But being careful, sometimes these tools were tailored just to justify higher fees. They are not to make an unbiased calculation, but this is just only to justify I put that the risks are very high, so this is why the fees are going to be higher than in the public sector. This is going to be part of the second talk, the textual analysis, so I'll skip it. And I will show ways people to follow. This is, again, totally biased, how I look at it, but basing on works from Williamson, Hart, Bajeri and Todelis, and applying that to the public-private. Instead of market versus hierarchies, you may think of the market as the private against hierarchy as the public provision. You also have people that apply strict finance to public-private contracting, so using the same tools as in the private sector, banking sector, to public-private contracting, or you can do a lot of empirics. The data sets are there. It's not very rich. These are very unbalanced. Probably the best data is provided by the UK and the World Bank. I'm doing some now stuff with reading contracts. So even if you have just only a library of documents, you can create a data set out of it. And we'll talk a little bit afterwards. This is so far as for public-private partnerships. So the picture to remember is, and the second one that addresses more John's concerns, and is going to be the introduction for the next one. Again, a PVP is not the hen, it's the pig. You have to be committed in the long term with profit sharing, with risk sharing. Sometimes it may also imply the risk of corruption.
Government profit, need the risk or the other way around?
Well, both sides are committed. Both sides have to be committed. So questions? No. We still have another talk.
They try to upload the coffee break.
Oh, that's a signal for a coffee break.
So one of the reasons why PPPs get so criticized in the UK, at least, it's not so much that the issues that we kind of been discussing so far, but actually that the administration of public projects has really improved. So if you just compare them to publicly run projects, the difference between them, between say 97 and 2010, has decreased dramatically. And so it's not really due to PPPs being so great or so bad, but really it's because the public administration has improved. Well, so my question is, is this sort of a solution for a transition administration, sort of a country with sort of medium institutions rather than good institutions?
Well, this is something that I haven't modeled yet. My models are very static. If you think in a more dynamic way, also this advantage of the public sector, of the private sector, may diminish in time. And the incentives to expropriate or to keep the private sector changes. There is a very nice paper by Marcus Opp in the JFE, where he shows that expropriation, there is a boundary where, depending on how much the public sector learns from the private sector, you have more or less incentives to expropriate. Bottom line, if the public sector cannot internalize the know-how, you will keep the private. But once the public sector can learn, and the private sector doesn't increase dynamically its advantages.
Wait a second. So we're talking about spillover effects, right, here? But they can go both directions.
Both directions. I mean, the
because
private,
what I see de facto is that in the Ministry of Finance, all the best people go work for a tax consultancy soon enough. And the public sector is not gaining any learning or experience, they're losing it. Because these public people get into contact with private people and see how much they earn. And they think, I can do that. And they leave the government. And because, so it can go both directions. It's not clear. So this is actually, is there any research on these dynamic effects?
This is not only people related. It's also how the public administrations, imagine the IT systems. Nowadays, the public administration has as powerful IT systems as the main corporations to deal with payroll. I mean, simple tasks. Previously, maybe 10 years ago, still the public sector was dealing with Excel and Ms. Smith completing on a paper and paperwork. Now it's, in many countries, it's done electronically, and this is a private practice incorporated by the public sector. So this is the sort of know-how that makes the public sector more efficient over time. And if the private sector doesn't have innovation enough to keep that gap, that makes an incentive for the public sector at the certain point to say, why should I contract it out if I can do it internally at the same efficient level? And it goes a little bit into what hopefully Anya will explain in the afternoon on the entrepreneurialism of the public sector. That the public sector is not only a public administrator, a manager, but becomes an entrepreneur in looking for solutions. And the more it goes to solutions, the more you can have the public sector also involved, and not only contracting it out. Imagine in the typical Williamsonian scheme, when do I contract something out? When the outsiders can do that better than I do. But if I'm the best, if my asset specificity, my knowledge is an asset, a specific asset. If I can do it, if it's not that specific, why should I contract it out? I can do it in-house. Okay.